Hello there, it's Francis here from Generational Wealth Academy. Now, on today's video, I am going to be sharing with you one of the ways in which you could hedge and win a losing trade. Yes, that is possible. How it is the case that there are times when we basically go into trades only for the trade, as it were, to turn against us. Well, it does happen. There's nothing much you can do about that, but when that happens, what do? There are times when you decide to just simply close the trade and take your loss and move on. But there are other times when you think to yourself, no, I'm not going to let this one go. And that's exactly what I'm going to be sharing with you today, one of such instances. I am currently in a trade, which turned against me, but now, I have, taken some steps to turn that into a winning trade. And these are basically the steps to take. As the title says there, hedging and winning a losing trade. Now, the first thing, to do, once you've entered a trade that turns against you, I am going to be going back to the chart soon, obviously. One of the things, the first thing you should do once you've entered a trade that turns against you is to open a second trade in the opposite direction. And by that I simply mean if you had entered if you had gone short, which means you sold, and it turns against you, what you would then do is to buy a trade heading in the opposite direction. Basically that would be a buy. Well, that would be a buy. That's to enter a trade in the opposite direction, which is a buy. So the first trade in this case, at least in my case, which I'm going to be sharing with you, I entered, I took a short position. It went against me. I entered a second trade with a long position. Now, having done that, you've hedged the trade. You've hedged the trade. What to do next is basically to now look for a high probability trade which you believe you will most likely win. Not as though any trade you enter the first time you should have done your analysis and at least be satisfied that it is a high probability trade before going in. Now let's just quickly go back to the chart. So even as I was explaining, this was the first trade, which was a sell. Obviously this is not where I entered. I entered way back in the future. I don't want to even begin to show where I entered. But anyhow, I entered a short position there, but the price went up against me. Now, what did I do? I then entered a second position there, which was a buy. So the first position, a sell at 0.01 lots. The second position, a buy at 0.01 lots, which basically means now if you were to measure the distance or the number of pips between the sell, where I entered a sell, and where I bought, you would see it was run about 125 pips or thereabout. That is huge. I'm sure you can understand why I was not going to let that go. I can't quite remember what happened. How I let it go how I let the drawdown build that much, but it did. So I was now in a drawdown of about over 120 pips before I eventually hedged the trade. What that means is that when you hedge basically in that way, it means that yes, your drawdown is probably about 120 or so, or 125. It would not get worse than that. Even if you were to leave the trade for 20 years, well, if we are still around to trade, or if the rules have not changed. But even if you were to leave the trade till the next week, what would happen is you will still be in a drawdown of 120 or 125, whatever the pip drawdown is, because you have hedged it. Basically what happens there is, this position, which was a sell, if it kept on going and I did not hedge it, it will keep on, the pip drawdown will keep on increasing. But because I hedged it, it means that when this sell position is going up, yes, the loss is increasing, or the drawdown is increasing. But because I have now entered a second position, that obviously being a buy, if the price keeps on going up, that one will be in profit. The second trade will be in profit, whereas the second trade will be in profit, whereas the first trade would, obviously still be in a loss. So whatever extra pips, is added to the losing trade would be gained or balanced out, as it were, by the winning trade. So when that happens, you then enter a third trade, which is, like I say, should now obviously be a high probability trade setup. Now let's go back. So that is basically what I've said here. Open the second trade as the hedge. So the second trade is the hedging trade. The third trade is the one to get you out of your drawdown, or at least help you recover some of it. Now the truth is, sometimes you would not necessarily recover all of the loss you are in, or you will not always recover all of your equity, but at least you will get some of it. In this case that I'm showing you now, I am actually still in a drawdown in pips, but overall I am now in profit. Let me explain. So you can see here now the pip count was over 30 a while ago, so you can see it's still dropping. So it basically means that I have three trades now. This was the first trade. If the price now drops below it, it means I would now have 2 winning trades against 1 losing trade. So what I currently have now is, one winning trade, which is the third trade I entered. That's a winning trade. This second trade is a losing trade because it was a buy, it's gone down. And the first trade, which I entered, which was a sell, is in a drawdown as well, although it's now a very little drawdown of less than 8 pips, which is good. So the first trade, just to repeat, the first trade is in a drawdown. The second trade is in a drawdown, but the third trade, which is meant to be the recovery trade, that is in profit. Now, what to do obviously is, when you are hedging, let me show you again. The second trade should be opened with the same lot size. That's one of the ways in which you can balance out, or you can stop yourself from having a bigger drawdown. The third trade, which is meant to be the recovery trade, you could use the same lot size, but in my case, I used a larger lot size. So you could use the same lot size or a larger lot size. Let me just basically highlight that. You could definitely use a larger lot, the same lot size or a larger lot size. I would explain the two. I want you to stay with me. You are going to really gain from this, I believe. So the first 2 trades, the losing trade was entered at 0.01 lots. The hedging trade was opened at 0.01 lots, the same lot size. I could have used the same lot size for the recovery trade, which would have meant that I would have to cover the 125 pips drawdown, because between when I entered the losing trade, the first trade, and the second trade, there was a huge gap or drawdown of about 125 pips. If I wanted to use the same lot size, to be able to come out of the profit, it means the third trade would have to move in my desired direction by at least that same number of pips, and even more for me to actually win the trade. However, what I have done, I decided to go for a bigger lot size. And you can see here, that's where I entered the trade. To where we are now, it's about 90 something pips. So that is good. So in a sense, I have, from the initial 125 pips, minus 96 pips, I only now have less than 29 pips to cover. I don't have to cover that now. Why? Because I used a larger lot size, which more than makes up for the drawdown I am in. So what I am going to be doing, because it's a Friday, yes, I'm recording this on the Friday, I don't want to leave this trade over the weekend, because who knows, this trade might then gap up, basically meaning that I could end up, even losing the trade. The whole exercise would have been pointless. So what I am going to do is basically close the trade. I could decide to actually wait for the price to come below the first entry, which basically means I win two trades and get even more, a bigger profit. Or I could close it now where I am, which obviously means I would still be in profit anyhow. So what I am going to be doing, even as you see the pip count there being at minus 29, I am going to close, I could decide to close all three trades now. I'll be in profit. Yes, I am in drawdown pip wise. With regards to the pips, I'm in drawdown, but with regards to the equity, I am actually in profit due to this larger lot size used for the recovery trade. Now I hope you're getting this. I would basically take you back to the text information so you would understand it more. So what I am going to be doing now, I'm going to be closing the trades one after the other so that you can basically see the change in the pip count. I'm going to start off by closing the long position, so that it's now left, I'm now left with two short trades. So let's close the long position. So just watch the pip counter change. I'm going to close the long position. Voila. So you can see, because I have now closed one of the positions, it now shows I am in profit. Definitely I am now in profit. So what I could decide to do is to hold on to these two trades, believing that it's going to go lower and I get even more pips. But really at this time of the day, I'm not willing to take the risk. I will just basically close out all trades. Well, even right before our eyes, you can see it dropping. I think I'll tell you what I'll do. I'll pause this video and give it some minutes and see what happens. I'll be back shortly. Well, you can see it's dropping very fast. Oh well. Well, you can see the price is going back up, it seems, and I really don't want to give back to the market what I've gained so far. So overall I am now in profit, having entered all the trades. So what I am going to do now is basically close the remaining two positions, and I would have succeeded in turning a losing trade into a winning trade. So basically, in a nutshell, that's how to do it. I've closed one extra position now, and I'll close the final one now, and it's all now closed. So even as we had gone through this before, this is basically how you would do it. I mean, if you're new to trading, well, or if you're relatively new to trading, then it might be the case that you have to spend some time, maybe go over this, watch this twice, so as to be able to know how to do it. Anyway, find time to visit our website. It's going to be at the bottom of this page, video, wherever you're watching it. Otherwise, that is the web address. Simply go to Generational Wealth Traders. That's one word, obviously all together. generationalwealthtraders.com. And I would say to join our Telegram group. Our Telegram group is a busy Telegram group. We do provide signals there, and we do invite you to join us for live trading, either the London session or the New York session, every week. So there's a lot to gain. Join our Telegram, and please subscribe and click on the like button if you're watching this on YouTube. Just help us get the numbers up, and I'll be very grateful. Okay, now until next video, God bless.